Gold is approaching a massive liquidity zone right now, and smart money is quietly preparing their next major move. We're looking at geopolitical shockwaves setting up a massive draw on price. In today's explainer, my absolute primary focus is a long setup targeting key higher time frame liquidity. But there's one very specific condition that has to happen before we even think about executing.
The primary objective is crystal clear, $4,173. That's the ultimate target. This is a massive pool of buy-side liquidity resting on the higher timeframes. It's the exact level where institutional algorithms are aggressively drawing price right now to balance out older market inefficiencies. But here's the problem. Most retail traders out there, you're looking at the exact wrong level right now. They're aggressively buying in extreme premium pricing, leaving themselves completely exposed to an impending trap. Let me break down where the institutions are actually positioning their orders.
Before we unpack the why, let's lock in the trading plan. Our daily bias is decisively bullish. The primary setup? We're waiting for a discount retracement. Patience is key here. Our high probability entry zone sits firmly between 40.88 and 40.98, and that ultimate liquidity target remains locked at 41.73. You know exactly what we're looking for. Now, let's look at the institutional reasoning behind it.
What's really fascinating here is where the immediate liquidity is pooled. Just look at these clean, relative equal highs building near 41.35. This is a highly vulnerable pool of buy-side liquidity. You've got retail stop losses clustered right about this level, and that provides the exact fuel smart money needs for a major upward expansion.
So, the crucial question is this: why is smart money going to attack this specific liquidity pool? What's the real institutional logic driving this highly engineered draw on price? It actually comes down to a perfect convergence of global macro events and technical order flow. Right now, the market is absorbing some profound fundamental shocks. On one hand, you have escalating geopolitical tensions, US CENTCOM strikes targeting Iranian military infrastructure, and Houthi forces threatening the Bab el-Mandeb Strait, which, by the way, is a crucial bottleneck for about 12% of all global trade. Then on the macro side, markets are pricing in a high probability of the Fed holding rates, which is keeping the US dollar index weak around that 101 level. These catalysts are exactly what dictates the flow of institutional capital. And you can see brilliantly how those macro events are translating directly to the price action. When we step back to the daily and 4-hour timeframes, the higher timeframe order flow is decisively bullish. Geopolitical fear is driving safe haven capital straight into gold. This lines up perfectly with the technical displacement we're seeing away from our discount arrays. Basically, institutions are using fundamental panic to fuel a highly precise technical delivery.
But wait, because the market is sending us a warning signal. Smart money rarely just moves price in a straight line. They require massive liquidity to facilitate their huge positions. And to engineer that liquidity, they rely on specific, scheduled economic data releases. We've got two major liquidity catalysts on the docket for today. First up, GBP CPI data hitting at 1 p.m. Then later at 9:30 p.m., we get USD crude oil inventories, right against the backdrop of WTI crude climbing past $84.50. You should fully expect these data drops to trigger the exact volatility the algorithm needs to engineer a liquidity sweep before the real expansion even begins.
To anticipate the next move, we absolutely have to look at what smart money just finished doing. Price recently swept major sell-side liquidity down at those multi-week lows near 39.60. Right after that purge, we got an aggressive institutional displacement to the upside. The accumulation phase is over, guys. The algorithm has officially shifted into an expansion profile. So let's talk about the precision ICT trade setup for our long scenario. It's time to move into the execution phase and map out an actionable institutional framework. Here is the exact institutional sequence we require for an entry. First, price has to retrace into our discount array between 40.88 and 40.98. We never catch falling knives. Second, we need to see a clear 15-minute displacement candle form inside that zone. That proves institutional sponsorship is stepping in. And finally, we execute the long position only when a fresh 15-minute bullish fair value gap is created. If you look at the 15-minute structure right now, price is heavily overextended into an extreme premium. If you buy up here, you literally become the liquidity. We are calmly sitting on our hands, waiting for price to drop back into this internal structure, sweep out those early impatient buyers, and mitigate the open fair value gap resting nicely in our discount array. Once those specific conditions are met, these are the rigid parameters we follow. The entry zone is 40.88 to 40.98. Our hard stop loss goes firmly at 40.73, safely below that 1-hour swing low. We'll take our first partial profit at 41.35 just to secure some capital, and we'll leave a runner for that ultimate higher time frame draw at 41.73. That gives us a beautifully asymmetric risk-to-reward ratio of 1 to 3.5. But let me be completely transparent with you. As of this exact moment, there is no trade. Smart money confirmation has not yet appeared on the lower timeframes. If price doesn't pull back to our discount array, or if it taps it but fails to give us that energetic bullish displacement, we simply do not execute. Capital preservation is always the priority. This incoming liquidity pool really changes everything. And that brings us to a critical question. Where is the hidden retail trap? This is the exact scenario that most traders are completely blind to. And it's precisely how the institutions are going to generate the liquidity they need to take this market higher. Just look at the stark contrast in market behavior here. Retail traders, driven purely by FOMO, are buying the early breakout at the absolute highs near 41.29. Meanwhile, smart money, operating with cold, algorithmic precision, is doing the exact opposite. They're sitting on the sidelines waiting for a 15-minute discount sweep to purge every single one of those retail buyers out of the market. The trap is beautifully clear right here on the 1-hour chart. Impatient buyers have tucked their stop losses just below the internal structure near 40.85. The algorithms are very likely going to drive price down to sweep that internal sell-side liquidity, effectively stopping out retail, and then use those clustered sell orders to fuel the real institutional expansion to the upside. Now here is where our thesis falls apart. If we see a full 1-hour body close below 40.73, this entire bullish setup is invalidated. A close below that level would indicate a structural shift to the downside, proving the institutional order flow has actually reversed. If that happens, we respect the invalidation level instantly, zero emotion involved. Let's synthesize all this into a rapid, tactical recap. The overarching bias is heavily bullish. Our key execution zone rests in a discount array between 40.88 and 40.98. The buy scenario strictly requires M15 fair value gap confirmation. Targets are the buy side liquidity pools at 41.35 and 41.73. And most importantly, your total risk exposure should never exceed 0.5 to 1% of your account balance. Strict risk management is simply non-negotiable. If you value this kind of calm, precise, institutional-level analysis using smart money concepts, then make sure to subscribe to ICT Market Theory. We strip away all the retail noise and focus purely on where the algorithms are drawing price. And if you're looking to actually execute these precise setups on a highly reliable platform, you can find the FXTM account link provided right in the pinned comment below this explainer. It gives you the exact institutional-grade environment you need for this level of execution. I'll leave you with this final thought as the charts continue to print. Understanding the narrative is only half the battle. Executing with discipline is the rest. So what's it going to be? Are you going to succumb to impatience and buy the retail breakout trap? Or are you going to wait calmly for the smart money discount? That choice alone dictates your outcome. Study the levels, wait for the algorithm to show its hand, and trade with absolute precision.